guys, so I'm going to now show you a different approach to managing your trades based on price action. So the first approach you learn in trading is really a binary approach, and binary means that the outcome is either minus 1R for losing trade or plus 2R for winning trade, right? You place your target price, your stop loss, and you let it hit either one of them. Of course, you could get a break-even trade when you shift your stop loss to entry price, when the price moves 1R in your favor. So this is more of a find and forget system. Now, another approach that you can use is to exit the trade based on price action, based on the candles that you see. So let me explain. So for long trades, we want the price to go up. We want to see bullish candles, right? So for example, we enter the trade somewhere over here and we see it going up, bullish candles, right? Now, the moment you see a first bearish candle that appears, all right, bearish candle, and what you can do is you can move your stop loss from the original position to a few cents below that first bearish candle to protect the profits that you've made so far. So the next day, if the price continues going down, you're stopped out. So that's the first thing you can do. Okay, so it says over there, shift your stop loss below the first bearish candle. Okay. Next, you can also shift your stop loss below the first bearish reversal pattern. For example, a bearish pin bar. So again, for example, you enter the trade over there, and then you got your bullish candles, you're going up, okay? And then you see something like that, boom, right? So you see a bearish reversal pattern, which may not be a red candle, could be a white candle or green candle. So if you see that, again, you can shift your stop loss to over there. So again, the next day if it reverses, boom, you exit the trade, okay? Or you can also shift your stop loss a few cents below the candle that hits the first level of resistance, which would be the moving average, the 20 EMA or the 50 moving average. So again, you're in the trade and you're going up. And what happens is you hit one of the moving averages. For example, you hit the 20 EMA. Okay, and you saw that the 20 EMA has been a previous level of resistance previously. Okay, so if you do that again, you could shift your stop loss a few cents below that candle. Okay, so as the price is going up, you're shifting your stop loss. Okay, so if the price reverses down, hits the stop loss, you're out of the trade. So this approach will create outcomes that are not binary. You will not get a minus 1R or 2R. You could get different outcomes. You could get 0.5R, 2R, minus 0.6R. So by doing this, what happens is that it tends to average your winners down a bit. So instead of getting 2R all the time, you may get an average of 1.6 to 1.7R winners. But at the same time, it will also reduce your losses. Instead of getting minus 1R for losses, it averages it to minus 0.6R on average. So it's really up to you which approach you want to use. A binary approach or this approach where you keep raising your stop losses. Both approaches will give you a positive statistical expectancy in your system. So just be consistent. So let me give you a few examples of charts where we use this particular approach. So this one is on FRAC, FRAC. And you can see over here, that was a bullish pin bar, and there is a divergence over there. Okay, that's supposed to be straight, right? Okay, so that's a divergence, and where do we enter? So we put our entry price a few cents above that candle, stop loss a few cents below. So the next day, what happens? The price goes up above the high, we get triggered. So we enter the trade on this day. But what happens? We enter the trade and it closes bearish. Okay, so because of that, what we do is we will raise our stop loss, which was originally over there, to over there. Okay, which is now SL2. Our stop loss is over there now. Okay, now the next day, what happens? The next day, the price doesn't go down, right? It goes up. So we have another bullish candle. So does this stop loss get hit? No, it doesn't. All right, so we keep the stop loss there. Okay, so with a bullish candle. Now the next day we have another bullish candle. Boom, okay? That brings it all the way up here, and lo and behold, it hits the resistance of the 20 EMA. What do? We now shift the stop loss from SL2 to SL3. Okay, so our stop loss is a few cents below this candle. Now the next day, does it go down? No, it's higher. Well, it's not high, it still goes down, but it's higher than the stop loss, doesn't get hit. We've got a bearish candle over here. So now we shift our stop loss to a few cents below this candle, which is the bearish candle. And the next day, what happens? Goes down, hits our stop loss, and we exit at SL4. So how many hours did we achieve? Okay, we achieved something like about probably 0.25 or 0.3 hour for this trade. Okay, if we had just let the trade run, you can see that it came all the way down and it would have hit our original stop loss if we did not shift the stop loss up. Okay, so by using this approach, it would have gained us a small profit instead of a usual -1 hour loss, in this case of a losing trade. Let's take a look at another example, Amber. Okay, so for this case, that was the bullish pin bar. Entry would have been a few cents above, stop loss a few cents below. So the next day, boom, we get triggered, right? So we're in the trade, it goes up to over here, this little candle over there, hits that moving average resistance. Okay, what we do? We shift our stop loss from here to over here, a few cents below that, because that's finding resistance. And the next day, it gets hit, boom, we're out of the trade. Okay, so what do we achieve this time? So for example, if this is 1 hour, we would have gotten a profit of roughly about 0.4 or 0.5 hour in profit in this particular case. Okay, here's another case. So this one was very clear winning trade. Zoom in. Okay, so that's our bullish pin bar. The next day we get triggered. Okay, so we're in the trade, goes up, bullish, 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 boom, first bearish candle. So the moment you get a first bearish candle, or the first bearish reversal pattern, or the first candle to hit a resistance, what do? You shift your stop loss to a few cents below that candle. So my stop loss is now in SL2. All right, got it? Next day, what happens? Goes up. My stop loss is not hit. We keep the stop loss there. Goes up again. Now this candle hits the resistance. So you could shift your stop loss to below this candle right now, SL3 if you wanted to. Okay. Next day it went up, didn't get hit, didn't get hit, didn't get hit, and it hits our target price of 2 hours. So this was a clear 2 hour win. So let's now take a look at examples for short trades. So similarly, for short trades, we shift our stop loss a few cents above the first bullish candle that appears, or the first bullish reversal pattern, like a bullish pin bar, or when the candle hits a support level. Remember, we're going short, we want the price to go down. So any indication that it is going up, we want to shift our stop loss to protect our position. So once again, by doing this, we may not always get our 2 hour wins. We may exit before 2 hour. At the same time, we will also exit before hitting -1 hour. So this tends to average winners to 1.6 to 1.7 hour, and average losers to -0.6 hour. Okay, and again, it creates a positive statistical expectancy. Here's an example of SJW. We have got a beautiful bearish pin bar over here. We take a trade, we go short, a few cents below, our stop loss is over there. Right? So what happens? The next day, we get triggered with a bearish candle, we get triggered again, boom. We have our first bullish candle. And not only that, but it looks like it's a pretty bullish candle. Okay, so what do? I shift my stop loss to the high of this candle over there. And the next day, it does not get triggered, it goes lower. But on this day, it gets triggered, so I'm out of the trade over here. And I just exit with maybe a 0.3 hour win. All right. Next one, YELP. Again, price goes up, bearish pin bar, and we've got an entry, our stop loss over there. Next day gets triggered, get a bearish candle. Okay, we have a bullish candle. So what do? shift our stop loss to the high of that bullish candle. The next day it goes bearish, we don't get triggered, so we keep our stop loss over there at SL2, keeps going down, hits our target profit, we're in for a 2-hour win. Few important points to note when trading, swing trading, especially for the BMR setup. Avoid entering trades if companies are going to announce earnings within the next 10 days. Because remember that if they announce earnings that goes against your direction, it could gap up or gap down and you could lose more than 1 hour. So it's best to avoid earnings, and in fact, you could also exit just before earnings are announced. Okay, how do you know when earnings are going to be announced? Well, if you look at the Think or Swim charting software, you can see a dollar sign. When you see the dollar sign coming up, right, avoid entering a trade. You can also go to any website like Google Finance, google.com/finance, and you can check the next upcoming earnings date for that stock you're going to enter. Next, exit trades before earnings. I just mentioned that. You can find the earnings calendar at that place. I just mentioned that. Next, avoid entering trades when stocks have less than 150,000 average volume a day. So we do not want stocks with low volume. They have to have at least 150,000 shares traded per day. And that is in the screening script that I have created for you. So when they screen the stocks, they will already filter out low volume stocks. Next, when you are going short, be careful to avoid shorting stocks less than $10, less than 1 billion in market cap, and avoid shorting stocks in the biotechnology or pharmaceutical industry. But when going long, no worries, right? We can go long on stocks less than $10, but avoid stocks less than $1, right? Between $1 to $10 is fine, and low market cap is fine for going long. Okay, so with that concludes our swing trading system for BMR. Again, it's one of my core trading systems I use to generate most of my profits, and I believe that it's going to do really well for you as well. And with that, I'll see you in the next lesson, which is a swing trading system 2.